Bismillahirrahmanirrahim. Assalamu alaikum. I am Syed Akif Shah, lecturer finance at Institute of Business Studies, Kohart University of Science and Technology. The title of this course is Business Finance and the course code for this subject is BS 151. This is lecture number 22 and the topic for today's discussion is expected return and standard deviation of portfolio of investments. Like the investor is going to invest in more than one security, and when he tries to find out the expected return and the risk measure, which is standard deviation from his investment, is the main agenda and focus of this lecture. The outline of this lecture comprises of the calculation measures used for finding the expected return of a portfolio of stock. As in my previous lecture, I have already explained that when an investor is going to invest in only one security or the share of only one company, then that cannot be considered or called as portfolio. When the investor is going to opt for two or more than two securities in order to make the combination of shares or the stocks in his portfolio so that the overall risk of his investment may be minimized, that is known as the portfolio management. So we can conclude that a portfolio consists of more than two financial securities investment. We will try to find out the measure and explain in detail that how to calculate the expected return of an investor from a portfolio of stock. Secondly, in this lecture, we will address the standard deviation or the measure of risk for two or more than two securities. The emphasis will be on the portfolio of two shares in this lecture and how to calculate risk measure, which is known as standard deviation for portfolio of stock. Thirdly, we will also explain shortly in this lecture regarding the covariance and correlation, which is very much important while constructing a portfolio of stock by any portfolio manager or financial manager, or even by an independent investor if he is expert enough or she is expert enough to make good bunch of stocks to be included in his or her portfolio so that the overall risk of investment may be minimized. Dear student, this is the general formula for calculating the portfolio expected return. It explains, let me select the pen. It starts with R bar, and in the subscript we are going to mention P, and this P represents that this expected returns belong to portfolio of expected return, which is equal to summation starts, summation sign needs to be included, and in the subscript we have seen J is equal to 1 up to the M. Like J is any particular investment or security we have included in our portfolio. So right from that first security to the number of securities 2, 3 or 4, whatever number is in the portfolio, all the portfolio needs to be summed up. This bracket starts with the WJ and then multiply by with the relevant. This J refers to the relevant jth stock which we have included in our portfolio, and RJ bar represents the expected return of the jth stock or jth share, the company's J share. So for one or a single company's expected return, I have already explained in my previous lecture how to find the expected return of a stock. If there are certain probabilities associated with that, then there is a particular formula to calculate. expected return for that single stock. For that, you are suggested and supposed to go and listen to my previous lecture on expected return for single stock. However, the emphasis of this lecture is on the portfolio expected return. So therefore, we will be focused on the portfolio expected return. This is the first section of the formula to calculate the expected return of the portfolio. This summation start J1 from M, and in this lecture our emphasis will be only on two stocks portfolio. So therefore the complete formula will look like you need to add for the next security, the weight of the next security may be K, multiply by with the expected return of the kth or the K company's expected return. So this summation is actually referring towards this plus sign, that you are required to sum up all the weighted expected return of the related securities. Let us explain. R bar P subscript P is the expected return for the portfolio. WJ is the weight of the investments proportion for the jth asset in our portfolio. Like this, J is referring towards J company and K is referring towards the K company's share. R bar J is the expected return for the jth asset, and M represents the total number of assets which we have selected two number of shares in our portfolio. So M is referring towards the number of assets in the portfolio. By using this formula, we can come up with the expected portfolio. We can come up with the portfolio's expected return. Now let us discuss the formula used for calculation of the portfolio standard deviation, which is a measure of risk. Sigma subscript P is referring towards the standard deviation of the portfolio, which equals to under the root of summation of all the stocks in our discussion, which is J and K. In our case, we have opted for only two stocks portfolio. One share has been referred by J and the second one has been referred by K, and both needs to be sum up, and the summation of what? The weight of J and the weight of K into this sigma J and K, which is referring towards the covariance between J stock and K stock. This weight actually belongs to, like, we are going to invest only $100 in total. Out of this $100, how many we are going to invest in J stock and how many we are going to invest in K stock is referring towards the weight. Like for example, we are going to invest $40 in the stock of J company and $60 in the stock of K company. Then the weight will be calculated by dividing the total amount of investment and then multiply it by 100. It will give you that we have invested 40% of our amount in security J and 60% of our amount has been invested in security K. So this weight can be easily measured depending upon the amount of investment you are going to invest in the relevant security, and then whole divided by the total amount of investment will give you the weighted investment in that particular stock. So therefore we can say that WJ is referring towards the weight of investment proportion for the jth asset in the portfolio, which we have calculated. It was 40%. Similarly, the weight of K refers to the weight investment proportion for the kth asset in the portfolio, which in our case was 60%, or another way around you can also write 0.6 if you are calculating or multiplying this weight with any mathematical equation. Then you are required to convert it into the decimal places so that you can reach to the resultant answer or value. And sigma JK refers towards the covariance between the returns for J and K assets in the portfolio. Here the major factor is this covariance, and in order to minimize the risk of your portfolio of minimize the overall risk of your portfolio of investment, the portfolio manager or the financial analyst or the manager is supposed to select those companies shares where the covariance between them is negative, because when the covariance is positive, the movement of the stocks will be positively correlated, or we can say that the movement of the stock will be in the positive direction. When the covariance between two stock will be negative, the increase in or the movement, positive movement in one stock must not be resulted in a positive movement in the second stock. We can say that the increase in the movement of one stock, then there will be a corresponding decrease in the other stock, and vice versa. So what is a covariance? Covariance is actually, as already been explained, that this is a very important factor for making the portfolio for a financial manager. And in the portfolio theory and in the financial business finance, the manager's primary motive is to select the negative covariance securities in order to minimize the risk, overall risk of the portfolio. Now, how to measure this covariance? This is very important because the formula was asking us to incorporate covariance with the weighted amount of the relevant security. How to calculate a covariance? Covariance is actually equal to covariance between the stock J and stock K is equal to the standard deviation of J stock. As in our previous lecture, we have explained that how to calculate standard deviation. Let's suppose the standard deviation of J stock is 10% and the standard deviation of K stock is, let's say, 12%. So we need to multiply the standard deviation of both stock and then further to multiply it with the correlation coefficient. Now, what is correlation coefficient? In our next slide, we will discuss in detail. At the moment, we can say that correlation coefficient explains, it is a statistical measure which explains the relationship between two variables. Now here the variables are J and K stock and their prices, stock prices. So if the relationship between two stock prices is positive, we can say that there is a positive correlation between two stock. And if the correlation coefficient between two stock is -1, which is perfect negatively correlated, then we can say that there is a negative correlation between the stock J and stock K. The sigma J, as earlier explained, is referring to the standard deviation of the jth asset in the portfolio. Since we have selected only two stock for making portfolio and then to find out the expected return of that portfolio and as well as the standard deviation of the portfolio. So therefore the sigma J, which is the standard deviation of jth stock, sigma K is referring to the standard deviation of the kth stock, and RJK is the correlation coefficient between the jth and the kth assets in the portfolio. What is this correlation coefficient? We will discuss it shortly in the next slide. Before moving towards the next slide, let me conclude on the covariance once again that the portfolio manager's prime interest is to select the negatively covariant securities in the portfolio so that the overall risk of the investor may be minimized. So therefore, the investor would like to avoid the securities which are positively correlated or covariated with each other to be included in the portfolio, because that will increase the overall risk of the investor. Now, what is this correlation coefficient? It is basically a statistical measure and it is a very much significance while you are making a portfolio of stock. And overall in the research phenomena, it has a a significant amount of contribution to explain the relationship between two variables or more than two variables. How to define it? It is a standardized statistical measure of the linear relationship between two variables. By linear relationship, we mean that there is a direct relationship there. By linear relationship, we mean to measure the one-on-one relationship between two or more variables. That is how those variables are correlated with each other. Like for example, if you would like to find out the correlation between inflation rate and the stock prices, then we can measure that with the passage of increase or with the increase of 1 unit in inflation in overall in the economy, there will be corresponding 1% increase in the stock prices of the listed companies on Pakistan Stock Exchange, let's suppose. Then in this case, if there is one-on-one relationship like +1 or positive correlation, we can infer that there is perfect positive correlation between inflation and the stock prices. Basically, its range is from -1, which is perfect negative correlation. If let's suppose there are two variables, one is variable x, another one is variable y. If the correlation between x and y has been found as -1, then we can say that there is a perfect negative correlation between stock x and stock y, or rather we have used the letter J and letter K in order to refer to the stock we have selected. So when the correlation coefficient found between the stock J and stock K is -1, then we can infer that there is perfect negative correlation between stock J and K, which is the prime interest of the portfolio manager. So if there is an increase in the stock price of Jth stock, there will be decrease in the stock price of Kth stock, and vice versa. Like there is an increase, if there is an increase in the Kth stock, so there will be a corresponding decrease in the Jth stock. So this is, it means that if one variable is increasing, the other one will be on the decreasing side. Similarly, if there is zero correlation found between the stock K and stock J, if there is zero correlation, then we can infer that, or the financial manager or the portfolio manager can infer that there is no relationship between the movements of stock prices of K and J. Like one variable has nothing to do with the second variable. In other way around, we can say that if there is an increase in the stock J's price, then we cannot infer that there will be increase or there shall be decrease in the stock price. It cannot be inferred if there is zero correlation, because these two variables are not correlated with each other at all. Similarly, if the correlation coefficient found between two stock, which is stock K and stock J, found to be +1, then there will be perfect positive correlation between two variables. Here the interested variable are the stock K and stock J. It means that if there is 5% increase in the price of stock K, let's suppose there is a 5% increase in stock K, and if the correlation coefficient between two variables, which is K and J, is +1, then there will be definitely 5% increase in the prices of stock J. So then financial manager are well-equipped and known investors' prime motive is not to select those securities for portfolio management which has perfect positive correlation. The reason behind this is If there is a corresponding increase at the end of the day or at the end of the year in the stock A, if there is increase of 5%, then no doubt there will be an increase of 5% in stock J. But what if there is a decrease of, let's say, 10% in stock K at the end of the year? Then definitely there will be decrease of 10% in stock J. So as a whole, the investors or portfolio manager will bear 20% decrease in the accumulated invested amount which they have invested at the very beginning. Like they have invested $40 in stock A and they have invested $60 at the start of the year in stock J, and it has been reduced by $6 because there is a decrease of 10% in the stock prices, and there could be a decrease of 10% which will lead towards -4. So from both securities the portfolio manager will bear a loss. So this is the prime reason that perfect positively correlated securities are not selected and suggested by the portfolio manager to make a good portfolio. The reason is the investors or the portfolio manager's prime purpose is to reduce the overall risk, total risk of the investor, because the ultimate objective of any investor or a financial manager or a portfolio manager is to earn the profit or to increase the rate of return on his investment. So this was all about how to calculate the expected return of the portfolio and how to measure the standard deviation of a portfolio. If you have any question, you are free to post them on KCMS and I'll be happy to answer your question. In the next lecture, we will take a practical example to use these two formulas to calculate expected return and standard deviation of two asset portfolio. Thank you very much once again for listening to this lecture. Good luck for the day. Allah Hafiz.